Hello everyone, welcome to EduTap and welcome to today's very important session. So today is your Finance Current Affairs revision session for your March 2026, which is a very important month from the examination perspective. For your RBI Grade B 2026 Phase 1 as well as for the Phase 2, the March 2026 is going to be very important. And in today's session, we will discuss the MCQs, and through the MCQs, we will try to revise and we will try to see the most important facts that you have to remember from the examination point of view, as well as we will also discuss the topics so that you have the clarity about the important topics and the facts that you have to remember from the examination point of view. So first of all, give me a thumbs up if I'm clearly audible and the screen is clearly visible. This session is going to be very important for all of you, and a lot of efforts have been taken to prepare for this session. Okay, so I hope you will enjoy the session. So good evening everyone. Good evening Yoganshi, Saurabh, Kshitij, Akshu, Avnish, Meera. This session is for your finance current affairs, where we will discuss the SEBI related articles, where we will discuss the IRDAI related articles and the Ministry of Finance updates that have been released. If the EPFO or the other regulatory bodies have released any particular direction or circular, or they have released some important idea that was quite in news in the March 2026. So all of this will be covered in this one session. And as you know that the SEBI related articles, the finance current affairs, they are important from the phase 1, because in the last year examination in the RBI Grade B, in the phase 1 there were 7 to 8 questions from the finance current affairs. In the phase 2 also there were 5 questions, like 4 questions for 2 marks and 1 question of 1 marker. So there were in total 9 marks worth of finance current affairs in the phase 2. So in the phase 2 as well as in the phase 1 of the RBI Grade B examination, the finance current affairs are important, and many of the students were saying that okay, from where they can cover the SEBI related circulars, from where they can cover the SEBI related articles for the RBI Grade B examination and the other finance current affairs. So this is your session where we will be discussing and revising the March 2026 most important finance current affairs. Okay, so shall we start now? Chalo. So let's get started. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos. We have planned a lot of sessions for all of you. So do subscribe to the YouTube channel and do join our Telegram channel, where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. So within 24 hours, the PDF is provided to you for the session. Okay, and this PDF will also be provided to you. Here I have collected the important facts, the important points, so that you have to keep in mind. Okay. Okay. So let's proceed now with the first question. First, we will see the question. If you are able to answer the question, that is very good. Just take a guess also. If you have not studied the topic, take a guess. Let's see how you are able to use your logical reasoning, how you are able to use your logical mindset and the elimination method. Okay. So first we will discuss the question, and then we will discuss the article related to that question. Okay, so there are approximately more than 20 questions. That means we are covering more than 20 articles, 20 plus articles we will be covering from the March. That are the most important articles. Now, recently the Niveshak Shivir held in Bhubaneswar was organized by which of the following institutions? So which of the following institutions organizes the Niveshak Shivir? This is a kind of question that can come in your phase 1. Try to answer this question in a fast manner. So recently the Niveshak Shivir was held in Bhubaneswar, and it was organized by which of the following organizations or institutions? So Niveshak Shivir is organized by IEPFA and SEBI. So IEPFA and the SEBI are the institutions that organize the Niveshak Shivir. Okay, so this is the right answer. Now this news was in your PIB, that's why it is very important. Now why the Niveshak Shivir is organized? So that the public can be made aware about the unclaimed dividends, about the unclaimed shares. So this is the aim behind the Niveshak Shivir. The Investor Education and Protection Fund Authority, the IEPFA under the Ministry of Corporate Affairs, in collaboration with SEBI, is organizing a Niveshak Shivir. Niveshak Shivir is organized as a one-stop facilitation platform to assist the investors, to make the investors aware in resolving their issues related to unclaimed dividends and shares, so that they can claim their unclaimed dividend and shares, okay, while also enabling direct access to investor services and on-ground grievance redressal mechanism. So this is the Niveshak Shivir that is organized for the investors so that they can claim their unclaimed dividend and the shares directly, as well as for the other services also. So under the Niveshak Shivir, IEPFA aims to provide direct facilitation for the recovery of unclaimed dividends and shares held for 6 to 7 years by the company. So company is holding the money, and if the investors, they want to claim their money back, if they want to claim their dividend and shares that the company is holding for the past 6-7 years, they can claim it through this Niveshak Shivir. On the spot KYC updation and nomination related services are also provided under the Niveshak Shivir. Immediate assistance and resolution of pending IPFA claim related issues. Okay, now the Niveshak Shivir was first launched in 2025. So here you can see that in 2025 the IPFA and SEBI launched their first Niveshak Shivir. Okay, now, coming to the second question, this is a very important question that can come in the examination in the phase 1 basically. Recently, Niveshak Shivir was organized by IEPFA and SEBI. In this context, after how many months are dividends generally classified, or the shares generally classified as unclaimed, and they are transferred to the Investor Education and Protection Fund? So if the company is holding on to the unclaimed dividends, if the company is holding on to the unclaimed shares or the interest on the dividends and such, so these unclaimed amount has to be transferred to the Investor Education and Protection Fund under the Investor Education and Protection Fund Authority after how many years, or after how many months here? So try to answer this question. I hope you remember that the companies, they have to transfer the unclaimed dividends, unclaimed share, the unclaimed interest to the Investor Education and Protection Fund after 7 years. Okay, once the 7-year timeline passes, once the dividend is not claimed for 7 years, shares are not claimed for 7 years, or the bonds that have matured, if they are not claimed for 7 years, so basically they have to be passed to the Investor Education and Protection Fund after 7 years. 7 years basically means how many months? 84 months. Here the right answer is D. Okay, so this is like these kind of questions have come in the previous year also, like for the deposits that you have, that are the unclaimed deposits. So the Reserve Bank of India has said that there is Depositor Education and Awareness Fund. So the unclaimed deposits, they have to be transferred to the Depositor Education and Awareness Fund after 10 years. Okay, once they have passed 10 years. Similarly, unclaimed dividend and the related unclaimed shares, the unclaimed interest on the dividend, unclaimed bonds which have matured, if they have matured and if they are unclaimed for 7 years, they have to be passed on to the Investor Education and Protection Fund. So remember these years, and here the month has been asked. The right answer here is D. Okay, yes. So D is the right answer. IPFA, that is Investor Education and Protection Fund Authority, is entrusted with the responsibility of administration of the Investor Education and Protection Fund, making refunds of shares, unclaimed dividends, mature deposits or debentures, etc., which are kept with the company to investors. So investors, they will be able to claim their money back. Even after 7 years, they will be able to claim their money back, but the investors will have to take the money from the Investor Education and Protection Fund. So under the Investor Education and Protection Fund framework, dividends, shares, the interest on the bonds and such, if they are unclaimed for 7 consecutive years, they are transferred by companies to the Investor Education and Protection Fund. This is the basic idea. Now coming to the third question, which initiative was launched by the National Housing Bank to simplify access to home loans for defense, paramilitary and government personnel? So there is an initiative that has been launched by the National Housing Bank to simplify the access to home loans for the defense, paramilitary and government employees, government officials. So which of the following is the initiative that has been launched? No, these are the new finance, like many of the students were saying that they were not able to cover the SEBI articles and such. That's why through this one session, I am going to discuss the important finance current affairs articles from the March that we have not covered previously. Okay, even if we have covered, still we are going to cover all the important finance current affairs in this one session. Yes, the right answer here is Grah Sugam portal. Okay, So very good. This is the right answer. So Grah Sugam, your trusted home loan platform. So National Housing Bank has released this initiative, Grah Sugam portal. This is empowering the government officials or the government employees, defense and paramilitary personnel with trusted home loan facilitation. The Grah Sugam portal is a digital platform developed by the National Housing Bank to revolutionize housing finance accessibility. Okay. So this is the basic idea. This is particularly for the empowerment of the government employees, defense and paramilitary personnel, for the serving as well as for the retired defense personnel and other government officials, by connecting them with National Housing Bank supported schemes designed to promote inclusive and secure housing. Okay. Now coming to the next question, with reference to recent changes and guidelines on investments from countries sharing land border with India, consider the following statements. There are recent changes that have happened in the guidelines on the investment that can come from the countries which are sharing the land border with India. So what are the new guidelines? As per that, you have to answer the question. Try to answer this. So investors from land border countries with non-controlling beneficial ownership of up to 10%, are they permitted under the automatic route in India? In case of investments from land bordering countries, majority ownership and control of the companies, they must remain with the resident Indian citizens or the resident Indian entities. This is correct. This is also correct. Proposals from land border countries for investment in the electronic components and polysilicon kind of manufacturing units must be decided within 30 days. No, they must be decided within 60 days. So these are the new norms regarding the investment that is coming from the land border countries with India. Okay. So the first and second statements are correct. The third statement is wrong, as it is not 30 days, it is 60 days. So 1 and 2 is the correct statement. That's why A is the answer. So first of all, Union Cabinet approved revised guidelines for the investment from countries that are sharing land border with India to ease the foreign direct investment that is coming to India. Okay. Incorporation of definition. So beneficial ownership or beneficial owner, they are the real person or the entity behind an investment or company, even if the ownership is through other companies or intermediaries. So beneficial owner is basically the person or the entity that is getting the ownership in the Indian company, okay. So that is the beneficial owner. Now investments with non-controlling beneficial ownership, that means the investors from the land border countries, they are investing in the Indian entities, but they are not having control. They are investing, that is non-controlling. So they are having the ownership that is not controlling. Up to 10% from land border countries, it is allowed under the automatic route. So that is the idea, that investments with non-controlling beneficial ownership, this is up to 10% that is allowed from the land border countries. This is allowed under the automatic route with lesser rules and regulations, basically. Subject to sectoral caps, but there are sectoral caps, sectoral limits that are implied. Mandatory reporting has to be done to the department for the internal trade and such. Now, expedited approval mechanism. So basically, investment proposals in specified manufacturing sectors to be cleared within 60 days. So this is the idea, that investment proposals that are being sent by the investors from the land border countries, the investment proposals in the specified manufacturing sectors, such as the investment proposal, the investors, they want to invest in the capital goods companies of our country or electronic components, the polysilicon and ingot wafer companies of our country. So for specified manufacturing sectors, the investment proposals, they have to be cleared within 60 days. They have to be cleared or they have to be rejected within 60 days. So within 60 days, answer to the investors. That is the idea. Any confusion? First statement. Now I hope this is very much clear, that investors from the land border countries, if they are having the ownership that is not controlling of up to 10%, that is permitted under the automatic route in India. Okay, that is permitted with lesser rules and regulations through the automatic route. So now I hope this is very much clear. Any confusion, anyone? This is the Department of Promotion of Investment in Internal Trade. Okay, so this is the idea, that first of all, beneficial owner is basically the investor that is purchasing the ownership in the company, that is purchasing the shares in the company. That is the beneficial owner. Automatic route for limited investments. So investment can happen through the automatic route by the investors from the land border countries, but the beneficial ownership can only be up to 10% if it is through the automatic route, and that should also be non-controlling. That should also not get the control, okay, of the company. And the reporting should happen to the Department of Promotion of Investment and Internal Trade. So this is the idea. And within 60 days, the proposals have to be cleared, either accepted or rejected for investment in the manufacturing sectors. Now coming to the next question, a very easy question. This kind of static question can also come. You need to know the full forms. It is very, very important. Okay. The SWIFT is set to launch a new framework for faster cross-border retail payments. See, SWIFT is a very important entity that takes care of the communication, that takes care of the messaging. See, let's say the State Bank of India wants to send the money, or the State Bank of India, the customer of the SBI, wants to send money to the Standard Chartered Bank of UK. Now, how the State Bank of India is going to communicate with the Standard Chartered Bank that, okay, the State Bank of India is going to send $1,000 to the Standard Chartered Bank. How this communication is going to happen? So see, the Society for Worldwide Interbank Financial Telecommunication, this is the entity, this is the society that helps in the communication between the financial institutions all over the world. Okay, so this is the idea. So SWIFT is set to launch a new framework for faster cross-border retail payments with implementation support from leading Indian banks such as State Bank of India, HDFC Bank, ICICI Bank and Axis Bank. What is the full form of SWIFT? So full form of SWIFT is Society for Worldwide Interbank Financial Telecommunication, so that the communication between the banks of the different countries can happen smoothly and the messages can be sent smoothly, so that the transactions can happen between the entities. So this SWIFT, it do not engage in the payment directly, it engages in the messaging or the communication between the banks for the payments. Okay, so that is the idea. So right answer first of all is B. So what is happening, that a new standard for cross-border consumer oriented payments, particularly for the retail payments, for the consumer oriented payments, there is a new standard or there is a new framework that the SWIFT is going to bring. So SWIFT has said that we are taking a bold step toward making cross-border payments as seamless, as smooth as domestic ones, because right now the cross-border payments take time. There are different rules and regulations that the different countries follow, and that's why the cross-border payments are not so smooth. So it is said that the SWIFT is going to take a bold step toward making cross-border payments as seamless as the domestic ones. In 2026, we will be launching a new scheme that is designed to deliver fast, predictable and transparent international payments for the consumers and the small and medium enterprises. Okay, so this is the idea. So first of all, SWIFT, it is a Society for Worldwide Interbank Financial Telecommunication. It was founded in 1973. The headquarters are in La Haye, Belgium. Members, over 11,000 financial institutions across more than 200 countries are the members of the SWIFT function. It provides a secure messaging network used by the banks, financial institutions for international financial transaction. SWIFT is not a payment system. It do not directly handle the payments. It only handles the global financial messaging network that is used by banks to transmit the payment instructions securely. Okay, so that is the idea. Now, SWIFT is set to launch a new global payments framework in 2026 that is aimed at transforming the cross-border retail transactions by making it faster, more predictable and transparent, cost certainty based. The initiative focuses primarily on the consumer and small business payments, small and medium enterprise payments. More than 50 banks globally have supported the scheme and over 25 banks are expected to begin processing. The initial corridors include countries such as Australia, Bangladesh, Canada, China, Germany, India, Pakistan, Spain, Thailand, UK and US. You do not have to remember the names, but remember that major Indian banks such as State Bank of India, ICICI Bank, HDFC Bank and Axis Bank are helping. They are part of this initiative that is reflecting India's strong participation as one of the largest remittance receiver economy. Okay, now the key features of the SWIFT new framework, there are going to be these 5 key features. That is a faster, more consistent experience the consumers, the small and medium enterprises will be able to gather. Upfront transparencies, that whatever fees, right now what happens that the customers are usually not aware that what fees will be charged from them for sending the money to abroad or for receiving the money from abroad. So upfront transparency will be provided through this new framework. Full value delivery, so if you want to send $1,000, that $1,000 will be sent. There will be no deductions that will be made. Okay, so there will be full value delivery that will happen. Whatever fee that will be taken separately and will not be charged from the amount that you are sending. End-to-end tracking and powered by existing trusted infrastructure. So end-to-end tracking will be provided to the customers, and global banking collaboration and inclusiveness will be provided. That is, the different countries will come together for this new framework. That is the idea. So these are the 5 features: more consistent experience, upfront transparency, full value delivery, powered by existing trusted infrastructure, and inclusive by design. Now coming to the next question, SEBI. This is related to SEBI. Now, in order to promote digital security of units of mutual fund investors, in consultation with the Association of Mutual Funds in India, MFI, SEBI has decided that a voluntary debit freeze facility will be introduced for the mutual fund investors. Through which platform will the mutual fund investors be able to access the debit freeze mutual fund facility in the first phase? Try to answer this, then I will explain it, okay? See, basically what has happened, that the SEBI, in consultation with the MFI, that is the Association of Mutual Funds in India, has decided for this debit freeze facility. Under the debit freeze facility, what the investors will be getting, that let's say I'm investing in multiple mutual funds. Okay, I'm investing in the ICICI Prudential Mutual Fund, I'm investing in the Nippon Growth Fund, I'm investing in the Motilal Oswal Small Cap Fund, or Medi Fund, that is medium cap fund, or the large cap I'm investing in. So I'm investing in multiple mutual funds. Now what happens, sometimes the frauds can happen and the debit of mutual fund units can happen from my account. And usually, because I'm, let's say, investing in multiple mutual funds, so sometimes I'm not aware about it, that okay, slowly and slowly from my mutual fund folio, some of the units are being taken out. Some of the mutual fund units are being taken out. So frauds can happen. So to safeguard the investors, especially the big investors that are investing in multiple mutual funds, so to safeguard the investors, this is the debit freeze facility that is provided, that you can freeze the debit from your mutual fund folio. That freeze the debit means that from your mutual fund folio, no one will be able to take out the units until you unfreeze it. That is the basic idea. Okay, so if you freeze your account, the units cannot be taken out until you unfreeze it. That is the debit freeze facility. So in order to promote digital security of your units of the mutual fund, in consultation with the MFI, SEBI has decided to provide a voluntary, you can voluntarily freeze the debit facility from your mutual fund folio, and through the which platform? Yes, Mutual Fund Central. So Mutual Fund Central platform, this will be the platform through which the mutual fund investors will be able to debit freeze, will be able to take this facility in the first phase. So right answer here is D. Okay, so this is the idea, that in order to promote the digital security of units of mutual fund investors, in consultation with MFI, it is decided that a voluntary debit freeze facility will be provided. It allows you to lock your mutual fund folios completely, so that no units can be debited, can be redeemed, switched, or transferred until you choose to unlock them. Okay, so in the first phase, the facility to lock the folio shall be provided to mutual fund investors by the RTAs, that are the registrar and transfer agents of mutual funds. So in the first phase, the facility of locking your mutual fund folios will be provided by the RTAs through the Mutual Fund Central platform, that is developed by the CAMS and KFIN technologies under the guidance of the MFI. Okay, that is the idea. Now coming to the next article, try to answer this. Which AI-enabled chatbot was launched as an easy-to-approach companion for taxpayers seeking information on the new rules like income tax rules 2026 has been released, Income Tax Act of 2025 has been released. So if you want to get the information on the new act, rules, forms, and related queries, which is the AI-enabled chatbot that has been launched? Try to answer this. Okay, everyone is able to answer this? Very good, Fruity. Very good, Kashish. Akshu, good. The correct answer here is Kar Saathi. Correct. Very good, Chetna. Correct. Here, Saathi is the answer. This we have also discussed in the Finance 360-degree session that the AI-enabled chatbot Kar Saathi, this was launched, which is an easy-to-approach companion for taxpayers that want to get the information on the new Act rules, forms, and related queries. So, if you have any query related to the Income Tax Act, income tax rules, and such, you can ask your queries through this Kar Saathi, that is a AI-driven tax help. Okay. Next, coming to the next, this also we have discussed the PRARAMBH 2026. So PRARAMBH stands for what? PRARAMBH stands for Policy Reform and Responsible Action for Mission Viksit Bharat. Is it the full form of PRARAMBH? It is the nationwide awareness campaign on the Income Tax Act 2025. The campaign reflects the Prime Minister's vision of a human-centric digital era through Madhav. So which of the following statement is or are correct? Which of the given above statements is or are correct? Try to answer. C. So I'm getting the answer 1 and 3. Okay, I'm getting the answer D also 1, 2 and 3. Think about it. Is it Madhav? Was it not Manav? It was Manav, okay? Not Madhav. That's why the third statement is wrong and the first and second statements are correct. So right answer here is C. So very good. Yes, only 1 and 2, okay? So first of all, PRARAMBH is policy reform and responsible action for Mission Viksit Bharat. This is guided by the spirit of Nagarik Devo Bhavo. PRARAMBH is a multimedia initiative spanning print, radio, television, outdoor, digital and social media that has been designed to build awareness about the key features of the new Income Tax Act, that is the Income Tax Act of 2025, that is in effect from 1st April 2026. Okay, so Income Tax Department rolls out PRARAMBH 2026. This is a nationwide awareness campaign on the Income Tax Act 2025. The campaign reflects the Prime Minister's vision of human-centric digital era through Manav, moral and ethical system that is accountable, that is having accountable governance, national sovereignty, accessible and inclusive AI, and valid and legitimate systems. Okay, so PRARAMBH 2026, it is basically for it is a basic awareness campaign on the Income Tax Act of 2025 that is set to come, or that has come into effect from 1st April 2026. Okay, that is the idea. Now coming to the next question, Sudarshan, this is also we have discussed in the Finance 360-degree session. SEBI has recently deployed an AI-based tool named Sudarshan, which is primarily used for which of the following purposes? Try to answer this. Sudarshan, why it has been launched by SEBI? To promote digital training platforms for retail investors, to provide automated portfolio management services to investors with registered intermediaries, to identify patterns of unregistered advisory activity and false claims, to provide real-time stock market investment, or to regulate cryptocurrency. The right answer here is C. Sudarshan has been launched to identify the patterns of unregistered advisory activity and false claims. I hope you remember that SEBI, like this we have discussed also, that SEBI has removed more than 1.2 lakh misleading social media posts by unregistered financial influencers, and the SEBI is using artificial intelligence tools to track violation in the digital space. So to strengthen the oversight, SEBI has deployed an in-house artificial intelligence system named Sudarshan. The tool scans large volume of audio, video and text content on a multilingual basis across digital platforms to identify the patterns of unregistered advisory activity. Investment advisors, they are registered by SEBI and only they can provide the advice, or research analysts, they are registered with the SEBI. So the intermediaries that are registered with SEBI, only they should be providing the advice or analysis. If there is the analysis or advice that is provided by the unregistered entities, that is the unregistered advisory activity and false claims they are making, then they will be removed from the platform, or their content will be removed from the platform. The AI framework is designed to proactively flag suspicious narratives rather than relying solely on the complaints. That's why Sudarshan is to identify patterns of unregistered advisory activity and false claims. Got it? C is the answer. Now, coming to the next question, which exchange has recently soft launched? Soft launch means a pilot launch has happened for the limited space. A global access platform to enable Indian investors. So which exchange in India has recently soft launched a global access platform to enable Indian investors to directly trade in international equities, debt instruments, and electronic trading funds? So see, the Bombay Stock Exchange, the National Stock Exchange, they are not like, they only provide the access to the Indian companies. But what if you want to invest in the foreign, in the international equities, debt instruments, and ETFs? Then what? Okay, so the Indian investors to directly trade in international equities, debt instruments, and ETFs, which of the following exchange has provided the global access platform? It is NSE International Exchange. Very good. And this is located where? This is located in Gift City or Gift IFSC. Okay. So Gift City is Gujarat International Finance Tech City, under which the NSE International Exchange is also established. Okay, so NSE International Exchange, this has recently launched in a pilot manner a global access platform to enable the Indian investors to directly trade in the international equities, debt instruments, and ETFs, exchange traded funds. So here, the recently National Stock Exchange, the NSE International Exchange, has launched the global access platform enabling Indian retail investors to directly participate in international financial markets. This initiative marks a significant step towards integrating domestic investors with the global capital markets, with initial access provided to the US market. And within the 3 to 6 months, there is the expansion that will happen to nearly 30 international markets. A key feature of the platform is the digital onboarding through the eKYC. The platform operates through the Gift City, that is Gujarat International Finance Tech City. Under the fund transfer mechanism, investors first send their money in the Indian rupees to a designated Gift City bank account, after which it is converted into the US dollars. Okay, these funds are then used to invest in global securities, with trade execution and settlement that is handled by the View Trade, that is a foreign brokerage firm operating in the Gift City. Remember this, View Trade, that is a foreign brokerage firm operating in the Gift City. Now, retail investors, that is the individuals, what is the limit of the money that they can send out under the liberalized remittance scheme? Under the liberalized remittance scheme, without much probe, you can send the money out, you can remit the money out, right? But how much money can be remitted under the liberalized remittance scheme in a financial year by the individuals? The limit is, how, if anyone remembers, what is the limit? Under the liberalized remittance scheme, what is the limit for the individual in a financial year, the money that they can send out? It is $250,000. Okay, so this is the idea. So under the liberalized remittance scheme of the Reserve Bank of India, outward remittances, or the money that can be sent out, up to 250,000 per financial year per individual. This is the limit on the individuals. I hope this is very much clear now. This is something that you have to remember. Coming to the next one, as per SEBI regulations on thematic and sectoral mutual funds, what is the maximum permissible portfolio overlap limit between two schemes of the same fund house? Try to answer this. Then we will discuss that what is the thematic mutual fund, what is the sectoral mutual fund, what is this overlap that is happening. All of this we will discuss. But if you know the answer, try to guess it or try to tell it if you know. Very good, Fruity. 50% is the answer. So as per the SEBI regulations, the thematic mutual funds and the sectoral mutual funds. So as per the SEBI regulations, the thematic mutual funds and the sectoral mutual funds, they can have maximum up to 50% of the overlap between the two schemes of the same fund house. So let's say a mutual fund house, a asset management company is providing, let's say ICICI Prudential, it is providing multiple mutual fund schemes. Okay, you must have seen that if you are investing in the market, you must have seen ICICI Prudential, it is providing a scheme for the small cap companies, Medicap, or the growth, direct growth fund is there. There is also the large cap fund. There is also the infrastructure fund. Multiple schemes are provided by a single entity. Now think about it, that first let's discuss this. Mutual fund companies, they often launch multiple schemes such as sector based funds. So let's say ICICI Prudential, Just taking the example, it can be any other fund, Nippon, Motilal Oswal, or any other fund. So ICICI Prudential, it is releasing a scheme, a mutual fund scheme that is investing in a specific sector, let's say banking sector or infrastructure sector or healthcare sector or energy sector or IT sector. Okay, theme-based funds are basically the funds that are invested in the particular theme. Renewable energy can be the theme, digital transformation, make in India can be the theme. So in make in India, the manufacturing sector is basically the theme. The urban development, investing in companies. So theme based funds, they are investing in companies across different sectors supporting that particular theme. So sector based funds, I hope it is clear that sector based funds, they are the mutual funds that are investing in a particular sector. Theme based funds, they are the mutual funds, they are the mutual fund schemes, that are investing in a particular theme, on a particular theme. They are investing in the companies related to a particular theme. Okay, so sector based funds of the same mutual fund company, it invests in a specific sector. Theme based funds, they follow a theme, and the mutual fund is investing in the companies across different sectors supporting that particular theme. Now what is happening, that there is a massive overlap. Let's say a same asset management company is providing different schemes, a sector based scheme as well as the theme based mutual fund scheme. Okay, theme is digital transformation. Now the sector based mutual fund scheme is the IT sector. Now, can we say that there is going to be a huge overlap between the companies that are being invested under the IT sector and the digital transformation? Digital transformation is what? Under the digital transformation theme, which companies will get the investment? IT companies, basically. Under the IT sector mutual fund scheme also, the IT sector companies are being invested on. So if you invest your money, let's say you want to diversify, you are investing in a theme-based mutual fund scheme as well as you are investing in the sector-based mutual fund scheme. But there is no diversification because the company is at last investing on the same companies. The asset management company is at last, through the different schemes also, the asset management company is investing on the same companies, on the same portfolio. So this was the problem that was coming, that the mutual fund companies, they often launch multiple schemes. The same mutual fund company, ICICI Prudential, or let's say XYZ asset management company, or let's say SBI and such. So various mutual fund companies, what they were doing, that they were launching multiple schemes, but there are multiple different schemes, they were having the same investment strategy, or they were having overlapping of the portfolio. So ideally each scheme should follow a different investment strategy and invest in different companies to ensure proper diversification. But in several cases, if we are talking about a mutual fund and the different schemes of the mutual fund, so different schemes were not having the diversification. Okay, however, in several cases, different schemes of the same fund house were found investing in nearly the same set of stocks. So even if you are investing in different schemes, you were basically exposed to the same kind of companies. There was no diversification that you were getting because of the overlap. So now, to address this kind of issue, it has been said that 50% is the overall ceiling cap. 50% is the limit, that is the max that overlapping can happen. So SEBI has mandated that the sectoral and thematic equity schemes, that means sectoral schemes and the theme-based schemes that are investing in the companies, in the shares of the companies, they shall ensure that portfolio overlap does not exceed 50% with other equity schemes and the sectoral thematic category and such. Okay, so this is the idea. First of all, I hope this is very much clear that let's say I am investing in ICICI Prudential sectoral mutual fund, sector-based mutual fund, okay, mutual fund scheme, and I am investing in the sector of automobiles and capital goods. Okay, so basically through the ICICI Prudential, I have taken the ICICI Prudential sector mutual fund scheme. Now this ICICI Prudential sector mutual fund scheme, it is investing in automobile and capital goods. Now I have bought another scheme of the ICICI Prudential. This is a theme based mutual fund scheme. So I am thinking that, okay, I have diversified my money, I have invested in 2 different schemes, and this is a theme based scheme that is having the theme of Make in India. Now what is happening, that 90% of the investment that is done by the sectoral mutual fund scheme, it is 90% investment is happening on the automobile companies and the capital good companies. Here in the Make in India category also, the manufacturing theme also, the investment is happening, 95% of the investment is happening on the automobile companies and the capital good companies. So by investing in 2 different schemes, am I getting any diversification? No. And if there is any problem that comes in the automobile and the capital good industries, I will be exposed completely, because when I wanted to diversify, I thought of investing in 2 different schemes, but I got the same kind of same companies that I invested in. So this is the problem that the SEBI is trying to reduce by saying that the maximum overlap can happen of 50%. Can happen of 50%. That is the maximum overlap that the 2 different schemes can have. Okay. So this is the idea. Yes, SEBI has mandated that sectoral and thematic equity schemes that are investing in the shares of the companies, they shall ensure that portfolio overlap does not exceed 50% with other equity schemes in the sectoral or thematic category and other equity schemes categories, except large cap schemes. Now, an important exception is provided for large cap mutual funds, which are not covered under this rule, because the large cap mutual funds, they are basically investing in the top 100 companies by market capitalization. So in the large cap mutual funds, there is the overlap that cannot be stopped, because they all are investing in the top 100 companies. That is the idea. Now the overlap condition shall be computed on a quarterly basis using average of the daily portfolio overlap values over a quarter. Okay, so the overlap condition will be computed for the quarterly basis, seeing the average of daily portfolio overlap values. Now let's say that there are many of the fund houses that already have a lot of overlap between the equity schemes, between the theme based and sectoral based mutual fund schemes. So in this case, there is a time period that is given. So existing sectoral or thematic schemes shall ensure compliance with regard to the portfolio overlap limit, that is 50%, within 3 years. So 3 years time period has been given from the date of this circular. Schemes unable to meet the portfolio overlap criteria after the 3 years shall be mandatorily merged with the other schemes. Okay, so that is the idea. So let's say there is overlap of 70%. So what is the excess overlap? First of all, if there is the overlap between 2 schemes of the same fund house, between the 2 schemes, there is the overlap of 70%. What is the excess overlap? Who can tell me? What is the excess overlap? 20% is the excess overlap. Now, in the 3-year time period, this excess overlap has to be reduced. Okay, so in the first year, 35% of excess overlap has to be reduced. So 35% of 20% has to be reduced. In the second year, the additional 35%, and that means in total 70% would have been reduced of the excess overlap. In the last year, remaining 30% of the excess overlap has to be reduced. So I hope this is very much clear now. Very good. So this is the idea that within 3 years, the overlap condition has to be contained, and within 3 years is the time period that is given. In the first year, 35% of the excess overlap has to be reduced. In the second year, additional 35% of the excess overlap has to be reduced. In the third year, the remaining 30% of the excess overlap has to be reduced. The overlap cannot be more than 50%. So whatever is excess, that has to be reduced in this manner. Now, coming to the next question, with reference to the recent issuance of the green infrastructure bonds, these are the bonds that invest in the renewable infrastructure, the green infrastructure, the sustainable infrastructure. Okay, so with reference to the recent issuance of the green infrastructure bonds in India, consider the following statements. State Bank of India became the first bank in India to issue the long-term green infrastructure bonds domestically. The bonds have a tenure of 7 years. The total green shoe option size of green infrastructure bonds is 10,000 crore. Try to answer that which of the above statements is or are incorrect, that you have to answer. Yes, Kshitiz, is there any confusion? So I hope you will be able to answer this question. See, it is State Bank of India. Anyone? No, it is Bank of Baroda. Bank of Baroda has become the first bank in India to issue the long-term green infrastructure bonds domestically. Okay, the bonds have a tenure of 7 years. Correct. The total green shoe option size of green infrastructure bonds is 5,000 crores. Okay, it is not 10,000 crores, it is 5,000 crores. So the incorrect statements are first and third, and that's why the right answer here is E. The right answer here is E. Okay, chalo. So Bank of Baroda has raised 10,000 crore through. Now, what is the green shoe option that we will discuss? But first of all, Bank of Baroda has raised 10,000 crore through long-term green infrastructure bonds, becoming the first bank in India to issue such bonds domestically. Green infrastructure bonds, they are issued to raise funds from the investors specifically for environmentally sustainable infrastructure projects such as the solar power projects, hydropower projects and such. They are environmentally sustainable infrastructure projects. The base size, the green infrastructure bonds issue comprised of base size. The base size was 5,000 crore, and the green shoe option. See, green shoe option is a provision in a bond or share issuance that allows the issuer to raise additional funds. The Bank of Baroda initially wanted to raise 5,000 crores. Okay, this was the target. But the Bank of Baroda said that if we are getting the investors, if the investors are interested in the bonds, then we will do the additional issue of 5,000 crore. So green shoe option is a provision in a bond or share issuance that allows the issuer, that allows the bank or the company to raise additional funds beyond the initial issue size. So initial issue size base size was 5,000 crores, but the green shoe option provided the additional fundraising option to the bank. That is the idea. Okay. So Bank of Baroda has become the first bank to launch such kind of green infrastructure bonds domestically. The base size was 5,000 crore. Green shoe option was 5,000 crore. The bonds carry a tenure of 7 years and a coupon rate of 7.10%. This is the interest rate. Okay. Compliance frameworks, issuers, they have to adhere to internationally recognized standards, that is International Capital Market Association green bond principles and the SEBI green bond guidelines and such. Credit rating, these bonds are rated AA stable by CARE Ratings and ICRA. Now coming to the next question, try to answer this question. Yes, the question was only asking about the green shoe option size. The total green shoe option size, that is 5,000 crore. So green shoe option size is 5,000 crore and the base issue size was 5,000 crore. Now try to answer this question with reference to the revised framework on the minimum public shareholding under the Securities Contracts Regulations Rules 1957. Consider the following statements and try to answer the question. The minimum public shareholding requirement is now linked to post-issue market capitalization of companies. This is correct. So the minimum public shareholding, see, all the companies, if they are releasing their initial public offering, or the companies, if they want to issue their shares to the general public, the companies that are releasing their initial public offering, the companies that are listing themselves in the market, they have to have the minimum public shareholding of 25%. That means 25% is the minimum that has to be provided to the public. But there is different timelines that can be followed. So minimum public shareholding requirement is now linked to the post issue, that after the issue, after the first time of the listing of the company in the market. So post issue market capitalization, the market value of the company. Okay. Companies with post issue capital up to 1600 crores must maintain at least 15% public shareholding at the time of listing. So these are the small companies that have the post-issue capital, that have the post-issue value of 16 up to 1600 crore. So they must maintain at least 25% of public shareholding at the time of the listing only. So this is incorrect. Companies with post-issue capital above 50,000 crore but less than or equal to 1 crore, they must reach 15% public shareholding within 5 years. So is it correct or incorrect? Anyone? No, they must meet 25% within 5 years. Okay. So here the right answer is 1 only. The correct statement is 1 only. Okay, we will discuss the idea in a better manner. Now let's proceed, but only first statement was correct. Okay, so right answer here is B. Now, first of all, see what happens that when the companies they are getting listed in the market, they have to provide the minimum public shareholding. That means they have to provide at least 25% of the shares to the public. So this is minimum public shareholding. At the time of listing, 25% has to be provided to the public. But usually the big companies, they are not able to provide 25% directly to the public at one go only. So that's why it has been said that on the basis of the market value, on the basis of the market size of the company after the issue, it is seen that how many years can be provided to a company to have the minimum public shareholding of 25%, to provide 25% of shares to the public. Okay, so this is the idea. Now, if the post-issue market capitalization after the issue has happened, if the market capitalization of the company, market value of the company will be up to 1600 crores, that is below or equal to 1600 crores, then minimum public shareholding at the time of listing should be equal to or greater than 25% to meet the minimum public requirement of 25%. Okay, so they need to meet the requirement anyway at the time of listing. But let's say that the post issue market capitalization is above 1600 crores but less than or equal to 4000 crore, above 1600 crore and less than and equal to 4000 crore. In this case, minimum public offer at the time of listing should be greater than or equal to 400 crore and they need to meet 25% of the minimum public shareholding within 3 years. Okay, now post issue market capitalization, if the company is a larger company that has above 4000 crore worth of market capitalization after the issue that happens, but equal to or less than 50,000 crore of the market capitalization, then the minimum public shareholding at the time of listing should be greater than or equal to 10% and 25% they have to meet within 5 years. But now the last point is that if, the next point is that if the post issue capital is above 50,000 crore but less than or equal to 1 lakh crore. Okay, so above 50,000 crore but less than or equal to 1 lakh crore. So they need to have the minimum public offer of 1000 crore, at least 1000 crore of minimum public offer should happen and at least 8% of the shares have to be provided and within 5 years 25% should be met. This is the idea. Now these are the criterias. Are they clear or not? So less than or equal to 1600 crore, 25% at the time of listing only. Above 1600 crores, but less than or equal to 4000 crores. So they need to have the minimum public offer of 400 crores or at least 400 crores or more than that. And within 3 years, they have to meet 25%. If the company has the post-issue market capitalization of above 4000 crore, but less than or equal to 50,000 crore, they need to do the minimum public shareholding of at least 10% and within 3 years they have to meet 25%. If the market capitalization, post-issue market capitalization is above 50,000 crore but less than or equal to 1 lakh crore, they need to provide the minimum public shareholding of at least 1000 crore and at least 8% and within 5 years they have to reach 25%. Okay. Chalo. Next, last 2 points are that if the company is very large, that means it has the post-issue market capitalization of above 1 lakh crore but less than or equal to 5 lakh crore, then the minimum public offer should be 6,250 crore, should be at least 6,250 crore and at least 2.75% of the minimum public shareholding should happen at the time of listing only. And within 5 years, if the public shareholding at the time of listing is below 15%, so if they are doing, let's say 5% or if they are doing 10% of the public shareholding at the time of listing, that is more than 2.75%, but below 15%, they have to reach 15% within 5 years and 25% within 10 years. But if, let's say, they are directly doing the public shareholding at the time of listing of 15% or above, then they have to reach 25% within 5 years. This is the idea. Okay. So if a company has the post-issue market capitalization of above 1 lakh but less than or equal to 5 lakh crore, then they have to do the minimum public offer of minimum 6,250 crore, and minimum of 2.75% has to be provided as the minimum public shareholding. If the shareholding is below 15%, then 15% has to be reached within 5 years and 25% within 10 years. If public shareholding at the time of listing is 15% or above, it must reach 25% within 5 years. Now coming to the company that is a very big company that has above 5 lakh crore of post-issue market capitalization. So they need to have the minimum public offer requirement at the time of listing of 15,000 crores, at least 15,000 crores they have to offer to the public, and 1%, 15,000 crore and 1%. Okay. In this case, if the company has the post-issue market capitalization of above 5 lakh crore, if let's say 15% is, let's say 15,000 crore is only, let's say it is 10%. Okay. Or it is not 10%, 5%, let's say, or something. Okay. It is 5% of the value of the company, then it is fine. So minimum of 2.5% of minimum public shareholding should happen at the time of listing. So even though I checked this in the main document of SEBI also, it has been said that above 5 lakh crore, if the company has the post issue market capitalization of above 5 lakh crore, then minimum 15,000 crore has to be provided to the public at the time of listing of the company, and 1% of the shares. But it has been said that there is also a minimum 2.5% of floor. That means minimum 2. I don't know why they have given this 1% when they have again given this 2.5%. So there is a clause that has been added that notwithstanding anything. That means in spite of everything, this 2.5% of the minimum listing should happen. So even though they have given this 1% also, but then they have also said that minimum floor is of 2.5%. Okay. This is a separate clause that has been added in the same document. This is the idea. Now this is the table that you have to remember, and if the public shareholding for the last two categories, if the public shareholding at the time of listing is below 15%, it must reach 15% within 5 years and 25% within 10 years. If public shareholding at the listing is 15% or above, it must reach 25% within 5 years. That is the idea. Okay. And if the question comes in the examination regarding the above 5 lakh crore, so the requirement is 15,000 crore, at least 15,000 crore of the minimum public offer at the time of listing, and 1% of the minimum public shareholding. But there is also the minimum floor that has been added, at 2.5%. Okay, at the time of listing. This is the idea. Any confusion here, anyone? Any confusion? Now coming to the next one. Recently, the minimum investment threshold in social impact funds has been revised. What is the new minimum investment limit? So SEBI has recently revised the minimum investment threshold in the social impact funds. This has been revised. What is the new minimum investment limit that you have to answer? So the minimum investment threshold in the social impact funds has been revised from 2 lakh rupees to only 1,000. C is the answer here. Okay. So there is a big change that has happened. So first of all, SEBI convened its board meeting on March 23rd, approving a wide set of regulatory reforms covering intermediaries, foreign investors and such. Social impact segment for this, the minimum investment threshold, the minimum investment that needed to happen for social impact funds under alternative investment fund regulation has been reduced sharply from 2 lakh rupees to only 1,000 rupees, so that more and more small investors can also invest in the social impact funds. This aligns with the zero coupon instruments, that are the instruments like the donation. You are giving the money but you will not get any interest. For the social impact funds, there are also zero coupon instruments. Okay, so this aim is to broaden the retail participation in the social stock exchange ecosystem, so that the retail investors, they can also invest in the social impact funds. At least 1,000 rupees they can start from. Okay, this is the idea. The permitting privately listed infrastructure investment funds to invest up to 10% in under construction. So this has been permitted that the privately listed infrastructure investment trust, they can invest up to 10% in under construction infrastructure assets. Okay. Now coming to the next question, try to answer this. Which of the following two entities have signed an MOU, Memorandum of Understanding, to strengthen India's startup ecosystem, and as part of this initiative, a dedicated platform, Startup Sahayak, has been launched to support early stage founders? So, which of the two entities they have signed an MOU to strengthen the India startup ecosystem, and as part of their MOU, as part of their Memorandum of Understanding, a dedicated platform has been launched? Reserve Bank of India and PhonePe, no. Minister of Electronics and Information Technology and Paytm, no. Niti Aayog and BharatPe, no. Small Industries Development Bank of India and Amazon, no. It is Department for Promotion of Industry and Internal Trade and Razorpay. They both have had a MOU to strengthen the India startup ecosystem, and under this initiative, a dedicated platform, that is Startup Sahayak, has been launched. Okay, so the MOU has happened to empower the startups with access to financial tools, founder enablement programs, and ecosystem support to assist the early and growth stage startups to use by using the digital payment solutions and such. Okay, so as part of this initiative, a dedicated platform, that is Startup Sahayak, has been launched to support early stage founders. The platform provides end-to-end assistance, including company incorporation, access to central and state government programs and schemes, and guidance on funding opportunities. Okay, so this is the idea. Remember, Startup Sahayak is because of the MOU between the DPIIT and the Razorpay. Okay. Next, recently under the amendments to the Finance Bill 2026, the turnover threshold for availing the startup tax benefits under the Income Tax Act 2025 has been revised. What is the new turnover limit? So previous limit was 100 crore. If you had the turnover up to 100 crore, you could take the startup tax benefits. But now this limit has been increased so that more startups, they can take the tax benefits. Okay. So what is the new limit now? What is the new limit now? So under the amendments to the Finance Bill 2026, the turnover threshold for availing the startup tax benefit has been revised, has been increased to 300 crore. So right answer here is D. Okay. D is the right answer. So the bill, that is the Finance Bill, seeks to align the Income Tax Act with the latest startups policy of the DPIIT. According to the amendment, as per the bill, the turnover limit for the startup tax holiday or the startup tax benefit has been raised by substituting the word 1 to 3 before the limit for the startup tax benefit, or the startups that had the turnover up to 100 crore, they could take the tax benefits. But now the startups that have the turnover up to 300 crore, they can take the benefit, effectively increasing the threshold from 100 crore to 300 crore. Okay, for taking the startup tax benefit. So these companies that have the turnover of up to 300 crore, they can take the startup tax benefits. Now next is, bill has also sought to tax buybacks. See, what is buyback of shares? First of all, buyback of shares means that the company sold its shares in the market. Now the company wants to buy back its shares. The company is buying back its shares. So now the Finance Bill has sought to tax buybacks in the hands of promoters with an additional tax. So what has been said, that let's say the promoters or the major shareholders, they are selling their shares to the company because the company is doing the buyback. So the promoters, the shareholders, they are selling their shares to the company. Now they bought the shares at the value of 100. When the company is buying back, the market value is 1000. So can anyone tell me that what is the profit that is made by the promoters? What is the gain to the promoters? Because they purchased it at 100, they are selling it at 1000. What is the gain? What is the gain? 900 rupees. Now this is called what? This is called capital gain. Capital gain. So it is said under the Finance Bill that this capital gain will be taxed additionally. There will be additional tax on the capital gain. Not only the additional tax, but there will be also a 12% surcharge on this additional tax as well. So that means the shareholders or the promoters that are selling the shares back to the company. So the company is doing the buyback of the shares, and the promoters, the shareholders that are selling back the shares to the company, whatever capital gain they are having, whatever capital gain they are making, on that they have to pay the additional tax, as well as the additional tax, they also have to give 12% surcharge on the additional tax. That is the idea, okay? So this is the idea. The bill sought to tax buybacks in the hands of promoters with an additional tax. A key amendment also clarifies that additional tax on share buyback will apply for only those companies that are doing the buyback undertaken under Section 68 of the Companies Act 2013. That means only for the domestic companies, this kind of additional tax the promoters or shareholders will have to pay. For the foreign companies, the same rule will not apply, okay? The bill also introduces a 12% surcharge on the additional income tax, on the additional tax on buyback gains. So whatever is the, first calculate the buyback gain, calculate the capital gain. Capital gain that is made by the promoter or the shareholder. On the capital gain, there will be additional tax, and on the additional tax, there will be 12% surcharge on the additional tax. That is the idea. Any confusion? So bill sought to tax the buybacks in the hands of the promoters. So promoters or the shareholders, they are getting taxed basically with an additional tax, and this additional tax will only be levied on the promoters or the shareholders that are related to the company under the Section 68 of the Companies Act 2013. And the bill also introduces 12% surcharge on additional income tax. Now coming to the next question. There are only a few articles that are left, so let's do them. With reference to the income tax rules 2026 notified by the Central Board of Direct Taxes, consider the following statement. So the income tax rules have been amended, they have been renewed. There are the income tax rules 2026 notified by the Central Board of Direct Taxes. So which of the following statements is or are correct? That you have to tell. So PAN is mandatory for cash deposits or withdrawals that are exceeding 1 lakh rupees in a financial year on aggregate basis. Is it correct? Free food or meal vouchers provided to employees are exempt up to 200 per meal. The 50% HRA exemption for metro cities has been expanded to Hyderabad, Pune, Ahmedabad and Bengaluru also. So actually the first statement is wrong because the PAN is mandatory for cash deposit or withdrawals equal to or exceeding 10 lakh rupees in a financial year. Okay. So exceeding 10 lakh rupees in a financial year on aggregate basis. This was wrong. The second and third are correct. That's why the right answer here is C. Okay. Yes. So first of all, the CBDT, that is Central Board of Direct Taxes. So the Central Board of Direct Taxes has notified that the Income Tax Rules 2026 to operationalize the Simplified Income Tax Act 2025 effective from 1st April 2026. Okay. Now enhanced tax benefit for HRA. So before 50% of salary could be calculated as the HRA only for 4 cities, that is Mumbai, Delhi, Kolkata and Chennai. Now 50% of the salary under the new tax rules, 50% of the salary can be under the HRA exemption for the 8 cities that are the Mumbai, Kolkata, Delhi, Chennai, Hyderabad, Pune, Ahmedabad and Bangalore. Okay. HRA exemption 40% of salary, that is unchanged. Next, children's education allowance increased to 3,000 per month per child. So this is some of the exemptions that have been provided. Free food or meal voucher exempt up to 200 rupee per meal, and gift voucher tokens tax free up to 15,000 annually. So these are some of the benefits that are provided. Okay. So there is the higher tax-free component. Significant relief for parents with children staying in hostels increased to 9,000 per month per child. This is the hostel allowance that has been exempted. Now, or that comes under allowances. Now, coming to the mandatory PAN. So, PAN has been made mandatory for aggregate deposits or withdrawals that are more than or equal to 10 lakh in a financial year. PAN is mandatory for purchase of motor vehicles, including two-wheelers, if price is exceeding 5 lakh rupees. PAN is mandatory if payment exceeds rupees 1 lakh for hotel, restaurant bills, banquet halls, convention centers, or event management services. PAN is mandatory if transaction value exceeds rupees 20 lakh for purchase, sale, gift, joint development of property. So here the PAN is mandatory. So these are some of the key provisions. The HRA exemption limit, that is 50%, it has been extended from 4 cities to 8 cities now. The other allowances, there is the children's education allowance that has been made higher tax-free component. There is hostel allowance, free food or meal vouchers, gifts, vouchers, tokens, they have been made tax-free up to 15,000 annually. free food meal vouchers exempt up to 200 per meal. Next, the PAN has been made compulsory or mandatory for these particular transactions that are happening. Okay. Now there is the introduction under the new rules. There is the introduction of a single common prescribed form for both registration of charitable trust and approval of for tax deductible donations, replacing the earlier multi-step process. So before there were multiple steps that had to be followed, but now there is a single common prescribed form for both registration of the charitable trust as well as approval for tax deductible donations. Provisional registrations that are not the final ones, but like your provisional degree, like your there are provisional registrations. This will be processed through centralized processing center instead of tax officers for faster and uniform approval. Trust can now easily exit the provisional registration. So let's say you wanted to work for the betterment of the society, so you thought of opening a trust. You took a provisional registration through the centralized processing center. You took the provisional registration, but after a few months you realize that okay, you are not able to focus on the trust. You have got a job, government job, you have cleared and such, so you are not able to continue with this trust. So trust can now easily exit. Now you can easily exit from this responsibility. So trust can now easily exit provisional registration if it is not utilized, reducing procedural complications. Before you had to fill a lot of forms, before you had to provide some of the documents and such, but now it has been said that you can easily exit provisional registration if it is not utilized, reducing the procedural complication. Additionally, record keeping has been limited to 6 years, lowering the compliance burden and cost, especially for smaller NGOs and new trust. Okay. Now coming to the next question, try to answer this question. IRDAI has announced the adoption of the India accounting standards for insurers. The regulations provide for parallel reporting for a period of how many years or such period as may be specified by the authority, comprising financial statements prepared in accordance with Indian accounting standards. Okay. So before, the insurance companies, they were following the generally accepted accounting principles. Okay. The Indian generally accepted accounting principles. So basically they were following IGAP. So insurance companies, they were following Indian generally accepted accounting principles that are the older principles that follow the old cost structure and such. Okay. They are the historical cost based accounting framework. They are the historical cost based accounting framework. Okay. So basically insurance companies, they were following the Indian generally accepted accounting principles, IGAP. These are the older principles. They are the historical cost based accounting frameworks. Now it has been said that the insurance companies, they have to follow the Indian accounting standards that are basically the newer principles that follow the global standards that is set by the IFRS. IFRS is the International Financing Reporting Standards. International Financial Reporting Standards. Okay. So basically the Indian accounting standards, they are the new principles. They are the modern principles or the modern standards for the financial reporting and such. And they follow the global standards such as the International Financial Reporting Standards. So from the older historical standards, now it is said that the insurance companies will be moving towards the Indian accounting standards that are the modern standards following the global standards. Okay. The IRDAI announced the adoption of the Indian accounting standards for the insurance companies. The regulations provide, now what has been said, that for the 2 years timeline, for the 2 years time period, there will be parallel reporting that will happen. The new financial statements under the Indian accounting standards and the older financial information, that both will have to be provided for the 2-year time period. Okay. So the regulations provide for parallel reporting for a period of 2 years, or such period as may be specified by the IRDAI, comprising financial statements prepared in accordance with the Indian accounting standards alongside the financial information under the existing accounting framework. That is the older framework that we were following. Okay. So 2 years is the parallel reporting. Any confusion first of all? So the Insurance Regulatory and Development Authority of India at its 135th authority meeting held on 30th March 2026 approved the IRDAI Actuarial, Finance and Investment Functions of Insurers Amendment Regulations 2026. So basically what has happened that these amendments, they mandate the presentation of the financial statements by insurance companies in accordance with the Indian accounting standards rather than following the Indian generally accepted accounting principles that are the older principles, the historical cost standards and such. Rather than that, now it has been said that you have to follow the Indian accounting standards with effect from 1st April 2026. Now, is it only applicable for a single category of insurance companies? No, it is applicable for all the different categories of the insurance companies. Let it be the life insurance companies, general insurance companies, standalone health insurers and reinsurers. They all have to follow the Indian accounting standards. Okay, so that the consistency, transparency, comparability in financial reporting across the insurance sector in alignment with the globally accepted standards, because the Indian accounting standards, they are they are aligned with the globally accepted standards of the IFRS. Okay, that is the International Financial Reporting Standards. International Financial Reporting Standards. Okay, so Indian accounting standards, they are aligned with the International Financial Reporting Standards. The previous ones, they were not. Now, the regulations provide for parallel reporting for a period of 2 years or such period as may be specified by the IRDAI, comprising financial statements that is prepared in accordance with the Indian accounting standards alongside the financial information under the existing accounting framework. Okay, as well as it is also said that to facilitate the smooth transition for insurance companies facing challenges in immediately shifting to the Indian accounting standards, a provision has been made to grant forbearance for 1 year, relaxed rules and regulations for 1 year in regards to the following the rules under the Indian accounting standards. Okay, so Indian accounting financial statements, Indian accounting standards financial statements, they shall reflect true and fair picture of the financial condition of the insurance company. Okay, coming to the next question, try to answer this. Any confusion, anyone? Try to answer this now. For the purpose of distribution of surplus to the policy holders and shareholders in an insurance company, which of the following is considered as the basis as per regulatory provisions? For the purpose of distribution of surplus to the policy holders and the shareholders in an insurance company, the actuarial surplus is considered on the basis of the regulatory provisions. So right answer here is D. Right answer here is D actually. First of all, see, distribution of surplus, actuarial surplus. Actuaries, they work in the area of insurance where risk and uncertainty is at the highest level. The insurance sector, it deals with a lot of risk. Within the insurance domain, the actuaries, they are involved in product design, pricing, valuation of liabilities and reserves, asset liability management, and research and analysis. So actuaries, they have a very big role as they are involved in product design, pricing, valuation of liabilities, reserves, and asset liability management and such. So actuarial surplus is the excess. The actuarial surplus is basically the excess of the insurance company's assets over its liabilities as per the actuaries, as per the valuation done by the actuaries. Okay, so actuarial surplus is the excess of the insurance company's assets over its liabilities, indicating, so actuarial surplus indicate the healthy financial position where current funds exceed the expected future liabilities. Okay, so actuarial surplus is determined under Section 49 of the Insurance Act 1938. This shall remain the basis for the distribution of surplus to policyholders and shareholders. Profit that is recognized under Indian Accounting Standard 117 is accounting profit. This will not be used for distributing the surplus. So basically it has been said that we are going to follow the Indian accounting standards, but when it comes to distribution of surplus, we will be following the actuarial surplus only. That is what has been said by the Insurance Act, that the distribution of surplus should only be based on the actuarial surplus. That is the idea. I hope this is very much clear. Okay. Now, Indian accounting standards financial statements shall reflect true and fair picture of the financial condition of the insurer And even though accounts will be prepared at the entity level, under the Indian accounting standards, the accounts will be prepared at the entity level, but the policy holders and the shareholders funds must continue to be disclosed separately only. Okay. Annual cohort requirement means insurers, the insurance companies, they shall comply with the annual cohort, annual insurance contracts. They have to mark separately, they have to record separately. So annual records have to be maintained separately. Okay. Life insurers offering, see, life insurers, they offer the unit linked investment plan. That means these are the life insurance plans that are also providing some investment facility. Okay, so this is the unit linked investment plans. They are linked with the investment. They must prepare, so life insurers, life insurance companies offering linked insurance plans, products, they must prepare separate financial statements for each segregated fund, because these unit linked investment plans, they are the insurance products, but they are also providing the investment facility in the different, on the basis of the risk profile and such. These funds are maintained specifically for policyholder investments, where the investment risk is borne by the policyholders, because the policyholders have agreed to take the investment product, to take the insurance product, and to allow a part of the premium to go to the investment according to the risk that the that the person wants to take, that the customer wants to take. Okay, so the unit linked insurance plans, usually they are the insurance product that are also providing that are also allowing a part of the premium to go for the investment as per the risk of the policyholder, as per the risk that the policyholder wants to take. Okay. Now, coming to the next one, with reference to recent amendments to the income tax rules, consider the following statements and try to answer this question. Okay, I'm giving you 1 minute, try to answer this. Any confusion anyone has in any of the topics that we have done before? No confusion? Chalo, let's proceed then. With reference to recent amendments to the income tax rules, consider the following statements. The definition of financial assets has been expanded to include crypto assets, central bank digital currencies, and certain electronic money products. Correct. These amendments aim to integrate digital assets into the tax information exchange system under the FATCA and CRS. Correct. The FATCA FATCA is an Indian law enacted to primarily deal with regulation of cryptocurrency. No, first of all, FATCA is a US law. Okay, so this is incorrect. So first and second are correct, and that's why the right answer here is E. So here, first of all, see, this is the article that the crypto assets, they are the digital assets based on cryptographic technology and distributed through the ledger system and such. Now, the financial assets under the income tax rules, or under the under the income tax rules, the financial assets now includes crypto assets, CBDC, central bank digital currency, and specified electronic money products. New reporting obligations. So financial institutions, they must report the holdings and transactions involving the digital assets, that is the crypto assets and such. Now, FATCA and CRS, what is this? The FATCA is the Foreign Account Tax Compliance Act. So FATCA is a US law enacted in 2010 to combat tax evasion by the US taxpayers holding assets in the foreign countries, in the foreign financial institutions. So it requires the foreign financial institutions to identify and report the financial accounts of the US citizens or residents of US tax authority. So countries, so India has signed a FATCA IGA in 2015, enabling the Indian financial institutions to report information through the Central Board of Direct Taxes. Okay, so the FATCA is a US law and we have to share the information with them basically. So if the US citizen or the US resident is investing in our country, or they have some assets in our country in the financial domain, so we have to inform the US. Next is CRS, Common Reporting Standard. Common Reporting Standard is a global standard for automatic exchange of financial account information between countries to combat tax evasion. It was developed by the Organization for Economic Cooperation and Development in 2014. So let's say the investors of our country, they are investing in the different countries. Now we are not aware about that how much capital gain, how much gain they are getting from the other countries. How the Indian government is going to know? So for this, there is the CRS, Common Reporting Standard. This is a global standard for automatic exchange of financial account information between countries so that the different investors can be taxed properly, appropriately. Okay. Now coming to the next one, try to answer this. Just 2-3 articles more, then we are finished. Recently, EPFO has launched a pilot project on the auto settlement of small inoperative accounts to ease the claim processing and reduce administrative delays. Under this initiative, what is the monetary limit for auto settlement of such inoperative accounts? What is the monetary limit for auto settlement of such inoperative account? The monetary limit is 1000 or less. Okay, this is the answer. C is the answer here. So basically 239th meeting of Central Board of Trustees of the EPFO happened, and EPFO has introduced a pilot project to automatically settle small inoperative account that have remained inoperative for a period of time, and under this initiative accounts with a balance of 1000 or less, they will be automatically disbursed. The money will be sent to the employee's account. Okay, EPF interest rate unchanged. So EPF interest rate has been retained at 8.25% per annum basis. Okay. For the third consecutive year, this is the interest rate that is going to be maintained. Amnesty scheme for exempted establishments. Now what happened that the board, that is the board of the EPFO, has approved a one-time scheme to address the compliance issues where the private provident fund trust. So these provident fund trust or these private companies, they are not sending the provident fund money to the EPFO. They are keeping the money with themselves. Okay, so they are the private provident fund trusts that are keeping the provident fund money with themselves. So the private provident fund trust, they were recognized by the income tax department but had not yet received a formal exemption from the EPFO. So income tax department recognized these private provident fund trust, but these private provident fund trusts, they have not got the formal recognition from the EPFO. So that's why the compliance problem was coming, that these private provident fund trust, they were providing the provident fund money, they were following the other rules and regulations, but they have not complied with the registration requirement with the EPFO. They got recognized by the income tax department, but they were not completely registered with the EPFO. The proposed, now what has happened, because they are not completely registered with the EPFO, that's why there were some penalties that were imposed on these private provident fund trust and such. So now the EPFO is saying that we have brought this one-time amnesty scheme. So the proposed scheme seeks to bring establishments and trust into compliance so that they are getting properly registered and compliant with the EPFO within a defined 6-month period, primarily to protect the workers' interest while waiving damage. So any kind of damage, penalty, interest will be waived off. The private provident fund trust, they will not have to pay any penalties because they were actually providing benefits under the provident fund scheme. They were providing the benefits, they were following the other rules and regulations. They just did not completely registered with the EPFO because they were recognized by the income tax department. So they were not much compliant, or they were not much aware about the EPFO registration also. Okay, so for the provident fund trust, the private provident fund trust that provided the benefits to their employees, but they were not compliant with the EPFO registration requirements and the other requirements. So they will have a 6-month timeline in which they will have to be compliant, and then their penalties will be waived off completely. That is the basic idea. So 100 active litigations can be resolved through this kind of amnesty scheme. That is the idea. So this is primarily to protect the workers' interest and waive the damage, interest and penalties for those private provident fund trusts that have already provided the benefits equal to or better than the statutory scheme. This measure is expected to resolve many litigations. Now coming to the next article, that is OECD. Try to answer this. Consider the following statements regarding OECD Pillar 2 model rules discussed in March 2026. So it establishes a global minimum corporate tax. See, OECD basically, when it comes to base erosion, let's say that in India, A multinational corporation, that is, or US based multinational corporation, that is Apple, if it is paying tax in US on its profits, it has to pay the tax of 30% or 35%. But if Apple opens its subsidiaries in Ireland, then Apple will only have to pay. In Ireland, the tax rate is only 10%. So where will you want to pay the tax? Where will you want to pay the tax? The Apple will open its subsidiary and will pay the tax in Ireland because only 10% of the profit is, only 10% tax is there. Or let's say Google has to pay the 35% tax in US, but Google is opening its subsidiary in Bahamas and will have to pay only 5% of tax on its profit. So rather than paying 35%, only 5%, 30% of profits will be saved. That will be in billions. So seeing this kind of situation, that many of the multinational corporations, they were opening their subsidiaries in the tax havens and they were trying to reduce the kind of tax they were paying. So OECD, under the OECD pillar 2, there was a minimum global tax that was imposed, that the multinational corporations, they have to pay this minimum global tax, that is minimum corporate tax rate of 15%. It is not 10%, it is 15%. So the OECD pillar 2 model basically establishes a global minimum corporate tax rate of 15% that has to be paid by the multinational corporations. So if the multinational corporation in US has to pay, let's say, 20% tax, they are opening their subsidiary in Ireland and only they are paying 10% tax. So in Ireland, they are paying 10%. The global minimum corporate tax rate is 15%. So minimum 15% they have to pay. That means 5% is left. They have only paid 10% in Ireland. So the rest of the 5%, this is known as the top-up tax, they will have to pay to their home country. That will lead to the minimum corporate tax rate of 15%. I hope this is getting clear, that if a multinational corporation open its subsidiary in another country to pay lesser taxes, then there is the global minimum corporate tax rate that has to be paid. The multinational corporations, they have to pay this global minimum tax rate of 15%. That means wherever they are paying, let's say in Ireland, a company is only paying 7%. So the global minimum corporate tax rate is 15%. So 8% is the top up tax that they have to pay in their home country. Okay. So in total, anyway, you have to pay 15% of the global minimum corporate tax. It applies to large multinational enterprises with consolidated revenue of at least 750 million euros in at least 2 of the 4 financial years preceding the current financial year. So in the out of the preceding 4 financial years, in the 2 financial years, if you had at least 750 million euros of the revenue, consolidated revenue, then you will have to be charged with this 15% global minimum corporate tax. So if you're trying to save the tax, if you're trying to save the money and not pay the tax, then anyway at the global level you will have to pay the 15% of the tax, okay, in totality. Now, the MCA has amended accounting standards 22 to align with these rules. Absolutely correct. So the second statement and third statements are correct. That's why the right answer here is B. Okay. First one is wrong because it should be 15%, not 10%. So first of all, there are 2 pillars of the OECD. Okay, OECD has 2 pillars. The pillar 1 talks about the corporate profits, how they should be taxed between the countries, the share of tax between the countries. The pillar 2 basically talks about the minimum corporate tax floor. That means this is the minimum, 15% is the minimum corporate tax that should be paid by the multinational corporations. If the domestic companies, they are paying 30%, 20%, 30% of the tax, so why multinational corporations are only paying 2%, 5% of tax? They should be paying at least 15% of the tax, and that's why there is the minimum corporate tax. Okay, so that's the idea. A key component of the OECD or G20 Global Tax Reform Agreement that establishes a global minimum corporate tax rate of 15% so that the base erosion and profit shifting can be reduced. The profit shifting can be reduced. Okay. Top up tax, I have informed you that let's say in one country, they are paying only 2% of tax. So the global minimum corporate tax rate is 15%. So in their home country, they have to pay how much? Can anyone tell me? That in Bahamas, a multinational corporation is only paying 2%. Okay, because they have opened a subsidiary, they want to pay the tax in Bahamas, they are only paying 2% of tax on their profit. So in their home country, how much they have to pay then? Very good, 13%. So this that they are paying in the home country is known as the top-up tax. So that 15% is the minimum corporate tax that is paid at the global level. Okay. So now this applies to large multinational enterprises with consolidated revenue of at least 750 million euros in at least 2 of the last 4 years, 4 financial years. It requires countries to impose a top-up tax if effective tax rate falls below 15%. So if effective tax rate is below 15%, then there is a top-up tax that is imposed. That is the idea. Now, key mechanism under OECD Pillar 2 model. So basically, these are the mechanism. Income inclusion rule. If a company pay less than 15%, company is paying 2% in Bahamas. If the company pays less than 15% tax abroad, its parent country, that is, let's say in US, will have to pay the extra tax of 13%, so that the global minimum corporate tax is 15%. Under tax payments rule, if the parent country doesn't collect the extra tax, other countries, see, if the payment country, that is the US, is not collecting 13%, is not aware about this whole situation, US is not collecting the 13%. So the good thing is that if the parent country doesn't collect the extra tax, other countries where the company operates, let's say the Google is operating in India, the Google is operating in various countries, so they get the right to tax the top-up tax. Okay. The home country, let's say in Bahamas, the US based company has opened the subsidiary and is paying 2%. Now Bahamas do not want the US to take the top-up tax of 13%. So Bahamas will start levying 15% of the top-up tax. Will start levying 13% of the top-up tax also. So the home country itself collects the extra tax also first before others can claim it. So this also can be followed. Okay. So this is the idea. Now it depends on the multinational corporation that where they want to pay. Now, next is Ministry of Corporate Affairs amended Accounting Standard 22 to align India's accounting rules with OECD Pillar 2 model rules. Pillar 2 basically says that minimum corporate tax rate should be 15%. Multinational corporations at the global level should be paying 15%. They should not pay 2% or 3% only or 5% only or 10% only. They should be paying 15%. If they are paying 2%, take 13%. So that in total they are paying 15%. So companies are exempt from showing their deferred, that is the future tax assets or liabilities related to Pillar 2 income tax. So deferred, that is in the future they are going to get some tax asset or tax benefit or the tax liability. So these kind of deferred tax liabilities can be ignored. Can be exempted. New disclosure requirements introduced. Disclosure of application of exemption. What they have exempted basically, separate reporting of current tax expense related to Pillar 2. So separate reporting has to happen, that how much tax they are paying. Disclosure of exposure of Pillar 2 taxes, the qualitative, quantitative like taxes that they are paying and such. Small and medium-sized companies are exempted from these disclosure requirements. Not very important, just the basic idea you needed to have, as well as the general rule is very important that the OECD, according to the Pillar 2, there is the global minimum corporate tax of 15%, as well as this is levied on the multinational corporations, multinational entities that are having the revenue, consolidated revenue of at least 750 million euros in at least 2 of the last 4 years. That is important. Now, coming to the next question. With reference to the Corporate Laws Amendment Bill 2026, consider the following statements. Try to answer this. Okay, just 2 more questions. The bill increases the upper limit. So we have discussed the Corporate Law Amendment Bill 2026 in a Finance 360-degree session. So bill increases the upper limit of paid up share capital to 20 crore and turnover to rupees 200 crore for small company. Absolutely correct. It proposes reducing the approval threshold for merger and amalgamation from 90% to 75% for shareholders and creditors. So that is also correct, that if mergers and amalgamations are happening in certain entities, so before the approval threshold was 90%, but now approval threshold is only 75% from the shareholders and creditors. The bill, that is the Corporate Law Amendment Bill, changes the net profit threshold to 10 crore or such other sum may be prescribed by the government for the corporate social responsibility. So before, if the net profit is 5 crore, then the corporate social responsibility norms have to be followed, but now it is 10 crore. Now it has been said, as per the bill, it has been proposed that the net profit threshold should be 10 crore. If you have the net profit of 10 crore and above, then you should be doing the CSR basically. So first and second are correct, third is wrong, and that's why the right answer here is A. Sorry, you had to answer incorrect statement, na? Incorrect statement. So first and second are correct, the third is wrong. So E is the right answer. E is the right answer, okay? I also didn't see the incorrect, but you have to be very careful in the exam, okay? So first is correct, second is correct, but third is wrong, and the incorrect is third only. Now, I have taken a detailed session on the Corporate Law Amendment Bill 2026. I'm not going to discuss it completely again. Basically, for the corporate social responsibility under the Act, under the Corporate Law, under the Corporate Law Act, or the Companies Act, sorry, under the Companies Act of 2013. Basically, the corporate social responsibility norms have to be met, and if the net worth is of rupees 500 crore or more, or turnover is of rupees 1000 crore or more, or net profit of rupees 5 crore or more, okay, but the bill changes the net profit threshold to rupees 10 crore or such other amount, okay. Scheme of merger or amalgamation, for the merger or amalgamation between two or more small companies, or between a holding company and its wholly owned subsidiary, before 90% of the approvals had to be taken, now 75%. Small companies, under the Companies Act of 2013, a small company is a company with a paid up share capital not exceeding 50 lakh or a higher prescribed amount not exceeding 10 crore, turnover not exceeding 2 crore, or higher prescribed amount of the turnover not exceeding 100 crores. Now these upper thresholds have been prescribed to be changed to 20 crore and 200 crore. Okay, 20 crore and 200 crore. So all of these we have discussed already. Now coming to the next question, with reference to the Bima Trinity, consider the following components, and which of the above correctly forms part of the Bima Trinity? I thought you people are getting like bored. So I'm like, do not worry, the session is going to finish. Just stay with me for these 2-3 more questions, okay? Because I know that there are so many of the articles, but I wanted to provide the content so that you are able to know that what are the important points, what things you have to remember. So yes, there is a lot of content, but I hope you are happy that you got the content in this session. And the time is less, so we have to be uh, a little concerned about that also, that we have to cover this. Now, with reference to the Bima Trinity, consider the following components. See, the Bima Sugam, Bima Vistar, and Bima Vahak. These three are the part of the Bima Trinity. Okay, Bima Suraksha is not a part of the Bima Trinity. So, Bima Sugam, Bima Vistar, and Bima Vahak, 1, 2, and 4. 1, 2, and 4. Anyone knows that what is Bima Sugam, what is Bima Vistar, and what is Bima Vahak? Any idea? See, Bima Sugam is basically your Amazon for the insurance products. Okay, so Bima Sugam is like a e-commerce platform for your insurance products. So in the Bima Sugam, you can buy whatever insurance product, like different insurance products you can see of the different companies. You want to buy the health insurance or life insurance or motor insurance, motor vehicle insurance. So any product of different companies you can see and compare through the Bima Sugam. So it provides you the end-to-end process, and it provides you the platform to compare the different policies as well as to buy the different policies and such. Then there is Bima Vistar and the Bima Vahak. Bima Vistar is basically a small affordable insurance product. Now this affordable insurance product, it is basically for the weaker section of the society, so that they can buy the insurance product at a cheaper rate, at a affordable rate. So this is a affordable insurance product that is providing basic insurance, basic health insurance, life insurance, and such. So various kind of insurances, it is merged into one insurance product, that is the small affordable insurance product. Bima Vahak, yes, very good. So Bima Sugam platform is set to launch standardized insurance products to simplify, streamline insurance offerings. Basically, see, Bima Vistar, first of all, this is a comprehensive all-in-one. Like I told you, that is, it is a affordable product. It is an affordable insurance product. Okay, so Bima Vistar is a comprehensive all-in-one composite insurance product that is designed to be affordable, especially for the weaker section of the society. So it is a composite insurance product where you are getting the facilities of the different insurance product in one insurance product. So different insurance product facility, like the health insurance you have to buy or the life insurance that you have to buy, so different insurance product facilities provided in this one affordable insurance product. So that is Bima Vistar. This is a comprehensive all-in-one composite insurance product that is designed to be affordable. Bima Vahak is a dedicated field level team that is focusing on rural areas to spread the awareness about the insurance product in the rural areas, with a preference for engaging women to build trust in the rural areas and to spread information about the Bima Vistar also. Okay. Now coming to the Bima Sugam, it was launched in September 2025, developed by IRDAI, and implementing agency is Bima Sugam India Federation. The aim is to create a unified digital platform for insurance services so that you can buy different insurance products that you want to buy from one place, to promote insurance for all by 2047, to improve accessibility, transparency and efficiency. So the Bima Sugam, it often described as a UPI-like platform for insurance due to its unified and interoperable design. It is a one-stop digital marketplace basically. Like in Amazon, you want to buy clothes, you want to buy accessories, sandals and such, you can buy different things at one place. Similarly here, if you want to buy different insurance products, health insurance, life insurance, motor insurance, home insurance, fire insurance, so you can get the different insurance products at one place for all the insurance products. Enables end-to-end services, purchase, renewal, claims, grievance redressal, zero commission model, and provides a unique digital identity. Okay, so this is the idea. I hope all of this is clear. We have discussed about the Bima Sugam, that is a digital marketplace basically for all the insurance products. Bima Vistar is a comprehensive all-in-one composite insurance product that is designed to be affordable, especially for the weaker section, rural areas and such. Bima Vahak, dedicated field level team focusing on rural areas, spreading awareness amongst the rural people about the insurance products, especially the Bima Vistar, with a preference for engaging women to build trust. Now coming to the last question, but after this we are going to discuss a few articles. The important points I will tell you. Yes, very good. So with reference to SEBI proposed IT resilience index for market infrastructure institutions, that is the brokers, sorry, the stock exchange. Market infrastructure institutions are the stock exchanges, the depositories and the clearing corporation. Under the market infrastructure institutions, there are the intermediaries, like the stock exchanges have the brokers, depositories have the depository participants, clearing corporations have the clearing members. Okay, these are the intermediaries of the market infrastructure institutions. So with the reference to the SEBI proposal IT resilience index for market infrastructure institutions, consider the following parameters. Which of the above are proposed to be used in the computation of the IT resilience index? Any idea, anyone? C. Okay. No, that is not correct. The right answer here is availability, security, integrity and modularity and flexibility. So 1, 2, 4 and 5. 1, 2, 4 and 5. B is the answer here. Okay. Sorry, 1, 2, 4 and 5. So E is the answer. 1, 2, 4 and 5. 1, 2, 4 and 5. See, these are the parameters. First of all, the SEBI has proposed IT resilience index, and these are the parameters of the index: availability, security, integrity, governance, reliability and monitoring, business continuity, modularity and flexibility, scalability and incident handling and such. So the IT resilience index, that is information technology, the market infrastructure institutions, the stock exchanges, they are handling so many of the transactions, or they are handling so many of the stocks, they are handling IPO, FPO and such. Then there is the depositories that keep your securities in the demat form. Then there are the clearing corporation that are doing the clearing and settlement function. So the IT infrastructure should be very resilient for these institutions. Okay, the information technology should be very resilient. It should be available, secure, there should be integrity, governance, reliability, monitoring and such. So the availability and security has the weightage of 20%, integrity 10%, governance 10%, reliability and monitoring 10%, business continuity 10%, modularity and flexibility 10%, scalability 5% and others 5%. So this is the idea. Okay. Now, SEBI has proposed this IT resilience index for the market infrastructure institutions. Availability means it should be ensured that there is system uptime, it is available to the investors or to the public as per the requirement, or to the intermediaries as per the requirement. Integrity, maintain the data accuracy, reliability and monitoring, ensure consistent performance, modularity and flexibility, adapt to the changes. So it should be flexible. Security, protect the data and the systems, because a lot of data is collected by the IT infrastructure of the market infrastructure institutions. Governance, adhere to the regulations. Business continuity, plan for the disruptions if there are any. Scalability, handle the growth, because so many of the new investors are joining the depositories, or they are joining the stock exchanges and such. They are joining as the investors. Okay, so this is the idea. Now, we are towards the end. I will give you a homework question. Before that, let me just show you some of the important points. So Government of India has announced its borrowing plan for the first half of the financial year 2026-27. So it has said that total market borrowings that will be done by the Government of India for the financial year 2026-27 has been revised to 16.09 lakh crore, and the borrowing will happen through the different kind of government securities. The maturity of 3 year, 5 year, 7, 10, 15, 30, 40, 50 years maturities. So through the government securities, the government will be borrowing from the market, and through the different maturities. Largest share is allocated to the 10-year government securities. Okay, so this is the basic idea, as well as yes, these are the important points. 15,000 crore worth of sovereign green bonds will also be issued. These are the bonds that raise the funds for the green infrastructure, for the green projects. Next is, government has also highlighted regulatory measures and prescribed timelines by IRDAI to ensure efficient, transparent and fair settlement of health insurance claims. So basically, India's health insurance sector has recorded strong growth of with premiums that is exceeding 1.2 lakh crore in 2024-25, growing at around 9%. So the health insurance sector of India has grown at around 9% in the 2024-25 time period. Next is, SEBI has issued a new framework that is allowing the custodians to offer certain financial services that are outside the SEBI's regulatory oversight. So custodians are usually the entities that keep in custody, that are the ones that are connecting with the customers, and the customers, the foreign portfolio investors, as well as the mutual funds, because they have so many of the securities that they are investing in. So they put these securities under the custody of the custodian, so that the custodian can safeguard the securities, okay, and can look after the investment that is done by the different entities. So the big entities like the mutual funds, foreign portfolio investors, they have the custodians. Now it is said that the custodians, they can offer certain financial services outside the SEBI's purview, but the custodians that are not backed by the banks, that means these are the custodians that are not banks, or they are not any subsidiary related to the bank, that is not backed by the bank. So custodians except that are related to the banks, so the non-bank custodians, you can say, or the custodians that are not anyway related to the banks, they can offer certain financial services outside the SEBI's regulatory oversight. And it has been clearly mentioned that if the custodian, they are providing certain financial services that are outside the SEBI's purview, and these facilities are being provided to the mutual funds or to the foreign portfolio investors and such, then the regulated and unregulated activities should be kept separately. SEBI has required the custodians to carry out such services that are unregulated by SEBI, that are not regulated by SEBI, through a separate strategic business unit. So custodians, if they want to provide some additional financial services outside the purview of SEBI, so the custodians need to have a separate strategic business unit to provide the extra financial services to their customers. Okay, to implement the new framework, a body called the Custodians and DDP's Standard Setting Forum, they will be responsible for publishing a list of specific financial services that custodians will be permitted to undertake outside the SEBI's regulatory purview. But these custodians should not be related to banks, or they should not be banks. Okay, SEBI has widened the pool of professionals that are eligible to conduct the annual compliance audits of investment advisors, research analysts, by permitting members of the Institute of Cost Accountants of India to undertake such audits. Now, basically, audits must be finalized within 6 months of the closing of each financial year. Compliance reports must be filed with SEBI or other relevant supervisory body within 1 month of the completion, with any remedial actions for negative findings reported by October for the preceding financial year. This is the basic idea. So that is the idea. Now, this is the homework question. Now, with reference to Udgam, see Udgam platform recently, the PIB, in the PIB, there was an article that was released that regarding the unclaimed instruments, regarding the unclaimed dividends or unclaimed shares, unclaimed investment products, uh, unclaimed deposits and such. So the SEBI is taking certain steps, like the Mitra platform has been launched, as well as the RBI is also taking certain steps. The Udgam platform has been launched. So now you have to tell me the with reference to Udgam platform launched by the Reserve Bank of India, consider the following statements. Now this is a homework question. So try to answer this question yourself. And in the comment section, do answer. Whoever gives the right answer, I will comment down below. There, like I will reply to them. Whoever gives the right answer. Okay. So as well as you should know about the full form of the Mitra platform of the SEBI. So what is the Mitra platform of SEBI? This is also related to the unclaimed something. Okay. So SEBI has the Mitra platform and the Reserve Bank of India has the Udgam platform or Udgam portal. So this is the question on the Udgam portal. Try to answer this question, as well as do tell me that what is the full form of Mitra platform of SEBI. What is the full form of Mitra? That is the idea that you need to have. So this is it for today. Do tell me that out of 25, how much marks you have got also, if you remember. And I hope today's session was interesting for you, was beneficial for you. Yes. So if you have the course of EduTap, then you have the current tap magazine. So GA plus finance section of March, we have revised. I have tried to bring the most important like concepts. I have tried to bring the most important articles from it. So just revise it through the document once now. Okay. So these are the most important topics that we have covered in this one session. So most of the topics have been covered, but I will still suggest you that go through your magazine so that any small points you can revise through there. Here you have understood the most important points. Okay. Chalo, this is it. Thank you everyone. Thank you for joining. Any other confusion that you have? I hope you enjoyed the session. Do tell me that out of 25, how much marks you have got. Do give the right answer of the homework question and do tell me that what is the full form of myth. This is it. I am also going to bring such a session for the RBI notifications, for the RBI press releases. So do tell me if it is required. For the March month, I'm thinking to bring such a session for all of you. So do tell me in the comment section if it is required, if you want such a session. Okay. So this is it. For the reports, see, the most important report will be the annual report now, because that is released most near to the examination. 31st of May it will be released, or 30th, 29th of May to 31st of 30th of May. So it can be released on 29th or 30th. So that will be the most important report that we will discuss in detail. Trend and progress has become very old now. If you want to go through it, you can go through it, but the data has become obsolete in comparison to the annual report that will be released in the end of the May. FSR also, it should release in June. So the previous FSR, I have released a session on that, I guess. If I have not, then the new one will be more important, or I will see that if the previous one is important, I will bring a session. Chalo. If you want a session on the RBI notifications, RBI press releases for the March, do tell me in the comment section. And tomorrow at 10 a.m. you have the Finance 360 degree session. So see you then. Okay. Thank you everyone.